Welcome to this session. In the previous class session, we have discussed some aspects of managing credit risk. One of the issue that we had discussed was screening and monitoring, and secondly we discussed the importance of long term customer relationships. And in this case, it's actually important developing a long term customer relationship. It benefits the customers, not only the customers but also the banks as well. So about the banks, the long term customer relationships reduce the cost of information collection and make it easier to screen out bad risk. So the cost of monitoring long term customers are lower than the cost of monitoring new customers. That is one important advantage for the bank. And what about the customers? For the customers, a long term customer relationship, a previous relationship with a bank will find it easier for a customer to obtain a loan from the bank at a low interest rate, because the bank has an easier time determining if the prospective borrower is a good credit risk, and therefore incurs fewer costs in monitoring the borrowers. Okay. So this is the advantage for the customers as well, and at the same time we have seen that it is beneficial for the banks as well. Now coming to third point, that means a loan commitment. A loan commitment is a bank's commitment for a specified future period to provide a firm with loans up to a given amount at an interest rate that is tied to some market interest rate. The majority of commercial and industrial loans are made under the loan commitment arrangements. So the advantage for the firm under this loan commitment is that it has a source of credit when it needs it. And for the bank, it promotes a long term relationship, which in turn facilitates information collection. And the third aspects of managing credit risk is the collateral and compensating balances. So a collateral, which is a property promised to the lender as compensation if the borrower defaults, and it lessens the consequences of adverse selection because it reduces the lender's losses in the case of a loan default. It also reduces moral hazard because the borrower has more to lose from a default. So to summarize the collateral, the main advantages are that it lessens the consequence of adverse selection and it reduces the moral hazard problems. And coming to the compensating balances, a firm receiving a loan must keep a required minimum amount of funds in a checking account at the bank. So for example, a business getting 10 million loan may be required to keep compensating balances of at least 1 million in its checking account at the bank. This 1 million compensating balance can then be taken by the bank to make up some of the losses on the loan if the borrower defaults. In addition to serving as a collateral, the compensating balances increase the likelihood that a loan will be paid off. They do this by helping the bank monitor the borrower and consequently reducing moral hazard. So specifically, by requiring the borrower to use a checking account at the bank can observe the firm's check payment practices, which may yield a great deal of information about the borrower's finance conditions. So for example, a sustained drop in the borrower's checking account balance may signal that the borrower is having financial trouble, or account activity may suggest that borrower is engaging in risky activities. Perhaps a change in suppliers means that borrower is pursuing a new lines of business. So any significant change in the borrower's payment procedures is a signal to the bank that it should make inquiries. Compensating balances therefore make easier for banks to monitor borrowers more effectively and are an important credit risk management tool. And then next aspects of tool of managing credit risk is the credit rationing. So, credit rationing takes two forms. The first occurs when a lender refuses to make a loan of any amount to a borrower, even if the borrower is willing to pay a higher interest rates. The second occurs when a lender is willing to make a loan, but restricts the size of the loan to less than the borrower would like. Okay. How does a small loan versus large loan affect moral hazard behavior? Initially, you might be puzzled by the first type of credit rationing. That means when a lender refuses to make a loan of any amount to a borrower, even if the borrower is willing to pay a higher interest rate. After all, even if the potential borrower is a credit risk, why doesn't the lender just extend the loan, but at a higher interest rate? The answer is that adverse selection prevents this from being a wise course of action. Individuals and firms with the riskiest investment projects are exactly those that are willing to pay the higher interest rates. If a borrower took on a high risk investment and succeeded, the borrower would become extremely rich, of course, but a lenders wouldn't want to make such a loan precisely because credit risk is very high there. The likely outcome is that borrower will not succeed and the lender will not be paid back. So, charging a higher interest rate just makes adverse selection worse for the lender, that is, it increases the likelihood that lender is lending to a bad credit risk. The lender would therefore rather not make any loans at a higher interest rate. Instead, it would engage in the first type of credit rationing and would turn down the loans. Financial institutions engage in the second type of credit rationing to guard against moral hazard. They grant loans to borrowers, but loans that are not as large as the borrowers want. So, such credit rationing is necessary because the larger the loan, the greater the benefit from moral hazard. If a bank gives you, for example, $1,000 as the loan, for example, you are likely to take action that enable you to pay it back because you do not want to hurt your credit rating for the future just for $1,000. However, if the bank lends you $10 million, suppose you have been given a loan of 10 million, so you are more likely to fly down to enjoy, celebrate this much money, and maybe the larger your loan, greater your incentive to engage in activities that make it less likely that you will repay the loan. Because more borrowers repay their loans, if the loan amounts are small, financial institutions ration credit by providing borrowers with smaller loans than they seek. So, these are all the key aspects of managing credit risk. Now, let us discuss the various aspects to deal with managing interest rate risk. So, one of the risks that banks often face is the uncertainty, the change in the interest market interest rate. So, the future interest rate, it can either increase or decrease, or it can keep same, it can be stable as well. So, what if there is an increase in interest rate, or what if there is a decrease in interest rates? So, in this case, what we do here is that the specific learning objective of this discussion here is to apply gap and duration analysis to manage, to identify the interest rate risk and to manage interest rate risk. Let us look at the balance sheet of a bank, very simple balance sheet. What we put here is that we put the assets and liabilities of this bank into two categories. In the assets itself, what we are going to do here is that we are making more rate sensitive assets and fixed rate assets. On the liability side as well, we put more rate sensitive liabilities and fixed rate liabilities. So, before going further, how do you see that whether the assets, whether they are rate sensitive or insensitive, or is the fixed rate assets or not? So, in order to identify whether they are rate sensitive or rate insensitive, so one tool, rule of thumb is that the small duration securities are more interest rate sensitive than the long term securities, because for instance, in the case of an increase in the market interest rate, you know that suppose rate of interest is increasing after 1 month. So, now thinking about that, when the rate of interest is increased, you know, for the bank, the transaction of the short term securities will be over in a short span of time, that means within 1 month. Then after 1 month, they will be transacting with the new interest rate, that the hiked interest rate. So, if these are assets, if the assets are more rate sensitive assets, then you may know that if suppose that the very short term, that means when the rate of interest increases in the market, they will be able to transact at the new rate of interest in the market, the high rate of interest in the market after 1 month, right. As I mentioned here, the transaction of the short term securities will be over in the short span of time, that is example 1 month, and same fund can be reissued or newly issued at the new rate. But what about the long term securities? Because the long term securities that can be transacted at the new interest rates only after the transaction process are completed, that means because these are long term. And also we also say that the bank, suppose these are fixed rate assets, they are not flexi rate, that means the agreement is not in a way that when the market rate of interest change, the rate of interest for these assets also change. Suppose that won't happen in the case of fixed rate assets. So, in the case of fixed rate assets, you can see that they have to wait for the long term, that means when the contract, the agreed period is reached. So, because of that we can say that they are rate insensitive assets, or we can call it fixed rate assets. So, this is about the asset side. And what about on the liability side? Liabilities means the payment that the banks have to make to their liabilities. So, rate sensitive liabilities, they are mainly variable rate certificates of deposits and mainly very short term money market deposit accounts. And the fixed rate liabilities, they are checkable deposits, savings deposits, long term CDs and equity capital. But based on this classification, we cannot infer whether they are really rate sensitive or rate insensitive. So, we can discuss in the subsequent session, in the coming minutes we can discuss what makes an asset and liability sensitive vis-a-vis insensitive to the rates. So, from this let us look that, let us take a case, both that this bank is having 80 million in fixed rate, and so that means 80 million in fixed rate assets, and the rate sensitive assets is 20 million, and total assets 100 million. So, 20% of these assets are rate sensitive assets. Of these liabilities, let us take that 50 million are rate sensitive liabilities. So, from this simply what you can see that what if the rate of interest increase in the future. So, in this case obviously you know that from the assets there from this 20 million that will be subject to new rate of interest. So, their income, the receipt of income will increase for this 20 million, but you can see from here itself, that means out of 50 million, that means for 50 million, 50% of the total liabilities are rate sensitive liabilities. So, that means the payment to the liabilities, that will increase, that means it is 50 million is there, right. So, taking an illustrative example of this one, total assets 100 million, rate sensitive assets is 20 million, and rate sensitive liabilities is 50 million. So, in this case take scenario 1, that means there is an increase in interest rate from, that means by 5 percentage point, from 10% to 15%. So, let us for the case assume that the interest rate rise is same for both the liabilities and assets. So, in this case what is going to happen? So, you can see from here that the income on the assets will increase by 1 million. You know how? Because 5% there is the rate of interest increased by 5 percentage points. So, 20 million. So, the 5% of 20 million, then you know that you can see that the bank's return from their assets increased by 1 million. Okay, fine. So, bank is happy, but you can also see the payments on the liabilities, but that also will increase by 2.5 million here. So, the 5% of 5 million, that you can see that 2.5 million. So, what is the change in the net worth of the bank? So, you can see that the increase in the income of the bank, that is 1 million, but the payment on the liabilities also increased, but that increased by 2.5 million. So, the net worth of this bank is changed, the changes in the net worth because of increase in the rate of interest, you can see that minus 1.5 million. So, in this case you can see that the bank's net worth has decreased. So, in this simple example that you can see that when this bank is having more rate sensitive liabilities as compared to the rate sensitive assets, an increase in rate of interest actually reducing the net worth of this bank. So, let us look at the second scenario, scenario 2. Suppose the scenario 2 is decrease in interest rate. So, in this case, what if the interest rates in the market fall by 5 percentage point on average from 10% to 5%. So, if the income on the assets decreases by 1 million, you can see that there is the income decline in income is 1 million due to decline in the rate of interest. So, the payments on the liabilities also decrease and is decreased by minus 2.5 million. So, what of the net worth changes in the net worth of this bank because of the decline in the rate of interest? You can see that the return on assets declined by 1 million, and but payment on the liabilities also declined, but that declined by 2.5 million. So, you can see that the bank actually, in fact, the net worth of the bank has increased by 1.5 million. So, from this what we can infer that if a bank has more rate sensitive liabilities than assets. So, in this case a rise in interest rate will reduce bank profits and a decline in interest rate will raise bank profits. These are the two inferences that we can make, important inferences that we can make from this discussion. What we have seen here is very basic analysis from this illustrative example, that means scenario 1 and scenario 2, and this idea that we can see that in scenario 1 the bank made the loss of net worth is minus 1.5 million, and scenario 2 we can see that the net worth was increased by 1.5 million. The same calculation we can get by using basic gap analysis. So, how to calculate the basic gap analysis? This is the simple formula for that. What we have to do here is that we have to put the gap in the rate sensitive assets minus rate sensitive liabilities. So, the gap between rate sensitive assets and rate sensitive liabilities and times changes in the rate of interest multiplied by changes in the rate of interest. So, in the first cases we see that the bank has made the increase in rate because of the increase in the rate of interest. So, we are getting increase in the rate of interest is 5%, that is plus that, right. That means you can see here is that the rate changes in rate of interest was 5 percentage points. So, in this case we need to calculate the gap is minus 30, that is rate sensitive asset, that is 20, minus rate sensitive liabilities, that is 50, times the 5%, that means 5% means 0.05. So, from here you can see that we are getting the answer, that is minus 1.5 million. So, in the bank, in order to understand the credit interest rate risk, bank often use this kind of formula, the basic gap analysis. However, these are certain limitation. What we have mentioned here is that we did not mention the duration of the assets and liabilities, because just to get you the idea simple, we just put this much is rate sensitive assets and this much is rate sensitive liabilities. However, you know that banks borrow short and lends long, that means most of its liabilities will be short term and most of its assets will be long term, that is one. And within different types of assets, you can see that there will be huge difference in the time, the duration, that the between short term and long term. So, similarly in the liabilities also there will be short term deposits and the long term borrowing the banks will be making. So, let us bring that one in our discussion and we can expand this basic gap analysis into basic duration analysis. So, here what we are taking, that we are taking an example of a bank with its total assets is 100 million, total that 100 million is the total assets and total liabilities is 90 million and bank capital is 10 million. So, in this case we need to calculate the average duration of assets, that is the average lifetime of the stream of payment. Suppose the average duration of assets is 3 years. For example, let us take 3 years is the average duration of assets. The average duration of liabilities, let us put it 2 years. And here what if the interest rates rise by 5 percentage points from 10% to 15%. In this case, let us see what will happen to the net worth of this bank. So, in this case the duration analysis, actually this duration analysis that we are going to discuss here, it is also called as income gap analysis. Here we calculate the percentage change in market value of security is equal to minus duration in years times percentage point changes in interest rate. So, here we calculate for separately for each security, that means for assets, and then we also calculate for the liabilities, and then we calculate difference between return on assets minus the payment on the liabilities. So, this can be expressed by a simple formula, that the percentage change in the price of a security. So, the P means you can use it as either asset and also you can use it for the liabilities as well. So, here taking this as an example, what we can see here that let us plug values in this formula. You can see that the market value of assets fall by 15%, because you can see that here you can see that the change is 5 percentage point increase in every year, right. So, you can see that for the assets duration, these are 3 years, 3 years is the duration for the assets. So, minus 3 years times 0.05, that the 5% of 10 million, and you can see that the decline in assets is by the changes in assets, you can see that this is 15 million. So, the market value of assets falls by 15%, and similarly the market value of liabilities is falls by 10%, that you can see you are getting minus 9 million. So, the net worth of this bank changes like this, that where the changes in the assets, the market value of assets is minus 15 million minus changes in the liabilities is minus 9 million. So, the net worth of this bank declined by 6 million. This is a simple illustration of basic duration analysis. However, we need to see that it may not be as simple as it looks, because average duration of the asset we just put 3 years and duration also we put 2 years. However, we need to elaborate, extend this analysis using weighted duration, which we will cover in the next session. Thank you.